Welcome to our next edition of the Secondary Market in Focus, a series of sessions where Altamar will share with our investors regular market updates along with our views and positioning in the face of the growing opportunity in the secondaries market. I am Derek Snyder, a managing director and partner of Altamar's investment team based in our New York office. And for today's session, I'm joined by Inés Soto, managing director, also part of the investment team based in Madrid. Today we'll cover an emerging trend in secondaries, liquidity solutions. We'll begin by defining these transactions and identifying the nuances that set them apart from more traditional secondaries. We'll also share our perspective on why we believe the COVID-19 crisis has created an interesting opportunity in this segment of the secondaries market. And finally, we'll provide some insight on how Altamar evaluates these transactions. Discussions of liquidity solutions in the press can be confusing and sometimes inaccurate, so we hope that this webcast will shed more light on this evolving trend in secondaries and that you'll find our insights informative and useful. To jump in, GP-LEDs is the most commonly used categorization for these transactions, but we actually believe liquidity solutions is a more appropriate way to describe these deals. By that we mean liquidity solutions are complex secondary transactions intended to recapitalize a fund or portfolio, an asset, or an investor base. Unlike traditional secondary transactions or plain vanilla secondaries, which are often a price negotiation between two counterparties, liquidity solutions also involve the GP or manager as a third party. By our definition, liquidity solutions come in three forms. The first and most common are fund restructurings. These often involve the sale of a portfolio of assets from a legacy fund to a newly created continuation vehicle that will be capitalized by new buyers and managed by the existing GP. Restructurings also include a set of new terms, more specifically, a resetting of economics and a provision for new follow-on capital to be deployed in the future. This is unlike a traditional secondary where there is no opportunity to change the existing terms. The second form of liquidity solutions are LP tender offers. These transactions are facilitated by the GP and offer LPs the option to tender or sell their positions to one or multiple buyers. Unlike restructurings, however, there is typically no resetting of terms or economics in tender offers. And finally, the third type are asset recapitalizations. These are processes to recapitalize the direct shareholder base, often of a single company, facilitated by a GP or a management team. These can be accomplished through the formation of a special purpose vehicle or SPV, or directly within the existing capital structure. But these transactions are very different from more traditional plain vanilla secondaries. A few key points of differentiation include liquidity solutions often provide the opportunity for much more detailed and intensive diligence. Buyers will often perform deep dive analysis on the portfolio companies, reviewing full financials, assessing budgets, and evaluating management teams. As such, the diligence process is more closely aligned with direct investing, and secondary funds with direct investment experience are best positioned to succeed here. As is the case with restructurings and recaps, these transactions allow buyers to reset economics to ensure proper GP-LP alignment. This includes new terms for fees and carry, but also the ability for the GP to reinvest in the portfolio alongside the new buyer to create a skin in the game dynamic. This is quite different from plain vanilla secondaries, where there is no ability to reset alignment. And this can often pose a problem for buyers, particularly in the case where a GP is not properly incentivized to act in the best interests of their investors. Also in restructurings and recaps, buyers will typically request some form of control rights at the fund and sometimes even at the asset level. These might include terms like a no-fault divorce, which is the option to remove an underperforming GP, or limitations or approvals on the uses of new capital or the sale of assets, for example. Another factor is the GP is involved in all facets of these negotiations. So as a buyer, you're negotiating both with the potential seller on price, but also with the GP on terms. So a skillful buyer is able to fine-tune their tactics to achieve their desired outcome in understanding the motivations of all parties. Given these added dimensions, the timeline to close is often far beyond a typical secondary deal, in our experience often requiring 6 to 9 months. And finally, the return profile for these transactions tends to be much higher. Market participants indicate they underwrite to between a 1.5 to 2x return, which is much higher than a plain vanilla secondary, which is typically between a 1.3x to 1.6x expected return. It's important to point out that all these nuances make liquidity solutions more complex than traditional secondary deals, but don't mistake complexity for risk here. In the case of liquidity solutions, the inherent complexity actually presents an opportunity to mitigate that risk by resetting terms, economics, and alignment to better achieve a desired outcome. Further, these complexities often deter less sophisticated buyers, as not every secondary fund is capable of executing these deals. Let's turn now to some market data. In the last several years, liquidity solutions have gained share in the overall secondaries market, a reflection of the increasing need as well as the attractiveness of these transactions. As you can see on the page, liquidity solutions now currently represent about 30% of the market, when just a few years ago in 2013, they were less than 10%. We expect a large number of GPs to take advantage of these types of processes in the future, and we believe we may eventually see liquidity solutions comprise up to 50% of annual secondary volume. At the same time, it's important to point out that liquidity solution transactions only work if they meet the needs of each party, the buyers, the sellers, and the GP. As such, they don't often occur at a meaningful discount to NAV. They are focused instead on realigning an asset or portfolio for growth and value creation in the future. This is very different from a traditional secondary bilateral trade or forced seller scenario, which is much more akin to a zero-sum game. Taking a moment to provide some more data around the liquidity solutions market. As I mentioned previously, restructurings and recaps are the most common type of deals and account for about 85% of the volume, with the balance about 15% in LP tenders. But the market reaction to these deal structures differs significantly. In both cases, LPs are offered the opportunity to either take liquidity or ride out potential future growth. But selling by the existing investors happens much more frequently in restructurings than in tender offer processes, 68% in restructurings versus 29% in tenders. Perhaps this is a reflection of the circumstances. In the case of restructurings, often something needs to change in the fund, and the existing LPs may simply decide to move on from that situation and sell. Or simply that in a restructuring, all LPs have to make a decision to sell or to roll into the new structure, while in LP tenders, no response is necessarily required. Liquidity solution transactions may also involve some provision for follow-on capital or new money to be deployed in the portfolio for growth initiatives, like funding add-on acquisitions for a buy and build play, for example. Finally, while these transactions may take place across different types of alternative strategies, traditional buyouts, growth equity, venture capital, infrastructure, etc., they typically only involve a handful of assets and by nature are more concentrated than a diversified portfolio of funds. As such, transaction leverage is not typically used in these deals. Liquidity solutions have captured headlines in the media many times over the last several years. There's no doubt that many of you are familiar with some of these transactions, or they may have even occurred within your own portfolios. However, what isn't captured in the headlines is the degree to which these transactions take place in all segments of the private markets, particularly on the smaller end of the market where we focus our sourcing efforts. Altamar alone has evaluated over 160 of these transactions, representing in excess of 40 billion of volume in the last 2 years. We were, of course, highly selective and only closed a small fraction of these opportunities, which we believe represented the best risk-return profile. Let me now turn it over to Inés to address how we believe circumstances related to COVID-19 will impact the market for liquidity solutions.
Hello. As Derek mentioned a few minutes ago, I'm Inés Soto. I'm Managing Director in the Private Equity team at Altamar. First of all, I wanted to address the impact we believe the current crisis will have in the liquidity solutions market. The COVID-19 crisis should benefit the appearance of new attractive opportunities in the liquidity solutions space. The reason for this, as described in slide 7 of the presentation, are the following. First, revaluation potential. During the last years, valuations have been consistently growing quarter over quarter, with many buyers being cautious in the most recent times especially, to avoid overpaying. Due to the crisis, an important revaluation is expected to take place in Q1 and Q2 this year, and this will rationalize entry points. We are actually already seeing this revaluation taking place in Q1, with an average decrease for funds currently standing at circa 8%. These Q1 valuations are decreasing mainly due to the public market's decrease as GPs usually base valuations on comparable analysis, while in Q2, the impact of the COVID crisis will start to show up in the company's operational performance. After these revaluations, buyers will therefore be very well positioned to capture the next upswing in the market. Second factor that will benefit liquidity solutions is the expected extension in liquidity timelines. The COVID crisis, like any other crisis, will also slow down the M&A market in the short and midterm. GPs are not willing to sell their assets at any price. Therefore, many companies that were probably expected to be sold in 2020 or 2021 will be kept within the manager's portfolio for a couple more years than expected in order to maximize returns. For managers with funds nearing the end of their lives, the way of doing this is through liquidity solutions. Third factor is the opportunity for offensive plays that the current crisis will create. The expected decline in valuations in the coming months presents a strong case for buy and build strategies, as these acquisitions for quality platforms will now be done at attractive prices. Asset recaps and fund restructurings will be a way of obtaining further dry powder in order to carry out these type of strategies. Fourth factor are fundraising challenges. Many GPs will have to face a difficult fundraising environment in the coming years, and traditional primary fundraising processes will not be an option for everyone. Liquidity solutions coupled with annex funds or similar proposals will become an alternative for these GPs in order to get some fresh capital to invest and will catch the attention of secondary players as well as primary investors. Finally, the broad acceptance of these liquidity solutions in the market is also an important factor to take into account. Some years ago, the pursuit of a liquidity solution was sometimes viewed by the market as a signal of a distressed situation. Nowadays, as we have already commented, both GPs and LPs have acknowledged the attractiveness of this market. Therefore, these type of deals are accepted and pursued by the overall market participants, including top-tier managers. In terms of volumes, the perspectives of this market is well illustrated by the results obtained in the analysis shown on the right-hand side of the page, where we can see that approximately 44% of the GPs that were inquired will consider or may consider some sort of liquidity solution in their funds. This gives a sense on the amount of transactions that are expected to arise in the coming years. Moving to the next slide, and with all of the previous data in mind, we felt it would be helpful to share some of our in-house perspectives on liquidity solutions. The first one is that liquidity solutions will be a growing trend for years to come. As mentioned previously, GPs are very aware and open to these type of transactions, and we are actually seeing an increased creativity in how they are facilitated and structured, which we believe will be a key future driver. We actually expect liquidity solutions to represent around half of the total secondary market volume in the future. The second thought we would like to share is that transaction selection is key in this space. There are many deals out there and not all of them make sense. For example, in 2019, Altamar evaluated 95 liquidity solutions transactions and closed less than 10% of them. We believe that in order to be attractive, these transactions must have the right risk side, which includes proper GP motivations, quality assets to be acquired at a discount to intrinsic value, and a strong GP-LP alignment. In line with this, our third thought would be the importance of avoiding the zombies in this space. This means the managers that are pursuing these deals just in an effort to hang on or survive. In this sense, LPs should ask themselves questions like, does a GP posture appear to be driven simply by survival or by the opportunity? And to what extent is the GP willing to align with the new buyer? The fourth point we would like to share is the importance of experience, patience, and a partnership mindset, which are critical drivers of success. Liquidity solutions are usually complex deals, which require sophisticated buyers that are able to manage a process that can sometimes may take up 9 months until they close. Also, the relationship between the LP and the GP is usually a key factor to unlocking access to the best opportunities. Finally, we also believe these deals often provide the best risk-return profiles in the secondary market, and they typically exceed by far the targeted returns by traditional deals.
To conclude, we hope this has served as a helpful overview of how we view liquidity solutions in the context of the secondaries market. Should you have any further questions, please direct them to our colleagues on the IR team. They will be happy to speak with you directly or to organize a call with our investment staff to provide further details. Pilar, Monica, and Sarah's contact information is available on the screen, and they look forward to hearing from you. Thank you very much for your time today.